Somewhere tonight, a couple is standing in an empty living room holding a single brass key, taking a photo they'll post in 20 minutes. Sold, finally, the happiest day of their financial life. They have no idea what they just agreed to. Over the next 30 years, this exact house is going to quietly pull more money out of their pockets than every car they will ever own, every vacation they will ever take, and every subscription they'll forget to cancel, combined. By the time the loan is finally paid off, they will have handed over more than double what the house cost on the day they signed. This is not a story about a bad mortgage. This is the normal one, the one almost everyone signs, smiling, in a real estate agent's office, while somebody pops a small bottle of Prosecco in the background. A clock starts the moment the ink dries. 360 payments, stretching further into the future than most people have ever planned for anything else in their lives. A house doesn't rob you. It's far too patient for that. It eats slowly, one statement at a time, for 3 decades, and calls the whole arrangement building wealth. Right now, in 2026, the average 30-year mortgage rate in the United States sits around 6.5%. The median home price has pushed past $400,000. Run those two numbers together, and the math turns uncomfortable fast. In California, a typical two-bedroom rents for around $2,700 a month. Buying a comparable home costs close to $4,400. That's not a small gap. That's paying nearly 2/3 more every month for the right to call the walls your own. And here's the part almost nobody mentions. The people who already own homes aren't exactly celebrating either. Millions of them locked in mortgage rates near 3% back in 2020 and 2021. Now they're frozen in place, afraid to sell, because moving means trading that 3% loan for something twice as expensive. Economists have a polite name for this. They call it the lock-in effect. The blunt version, the housing market has partially seized up, like an engine nobody's allowed to change the oil on in 5 years. Picture a homeowner who refinanced back in 2021 at 2.8%. To move into a slightly bigger house today at 6.5%, they'd roughly double the interest cost on the exact same loan balance. So they don't move. They renovate the kitchen instead, mutter something about needing more space someday, and stay exactly where they are. So, whether you're trying to buy a home or you bought one years ago and have no plans to ever move again, the house is pulling on your finances from one direction or another. It's just choosing a different angle depending on which side of the door you happen to be standing on. To understand why, you have to stop looking at the price tag and start looking at the mechanism underneath it. Say you borrow $400,000 at 6.5% over 30 years. Your monthly payment lands around $2,500. Sounds manageable. Now look at where that money actually goes in month 1. More than $2,100 of it evaporates into interest. Only around $360 chips away at what you actually owe. The bank eats first. You get whatever's left on the plate. This isn't a glitch, and it isn't some hidden scandal. It's simply how amortized loans are built. Interest is charged on whatever balance remains, and in the early years, almost the entire balance still remains, so almost the entire payment becomes interest. It takes roughly 19 years, not 5, not 10, 19, before the math finally tips and more of your payment starts going toward the house instead of toward the lender. 19 years of paying down a debt before you're building equity faster than you're feeding interest. And most people never even make it that far. They move, they refinance, they sell, and the clock resets, right back into the expensive early years, forever feeding the part of the loan that benefits the bank the most. Look at the curve from the halfway point and the shape gets almost absurd. By year 15, exactly half the term, you will have made roughly $455,000 in total payments, and you will still owe close to $290,000 of the original $400,000 you borrowed. 15 years, $455,000 handed over, and the debt has barely been dented. That's not a typo. That's the loan working exactly as designed. And the mortgage is only the headline. It's the number printed in the brochure. It is not the number that actually leaves your account every year. Property taxes alone average a little over 1% of a home's value annually nationwide, higher in dozens of states. On a $400,000 home, that's close to $4,000 a year, a number that only grows as the home's value rises. Then, insurance. In Florida, California, and large stretches of the Gulf Coast, insurers are pulling out entirely or tripling premiums because climate risk has made certain homes prohibitively expensive to cover at all. Even in calmer states, premiums have been climbing faster than inflation for years. Then maintenance, the unglamorous machinery of a house aging in the background. The standard guidance among real estate professionals is to budget 1 to 2% of a home's value every single year just to keep it from falling apart. Roofs, water heaters, foundations, the boring stuff nobody photographs for the listing. On that same $400,000 home, that's another $4,000 to $8,000 a year, money that builds no equity and earns no return. Its only job is preventing a bigger, more expensive emergency 3 years from now. Nobody mentions any of this at the closing table. Nobody says, "Congratulations, you've just also subscribed to an unpredictable annual fee with no cancellation option." But that's closer to the truth than "you just bought a house." Add it up properly, and the picture changes completely. That $400,000 loan at 6.5% over 30 years, you don't pay back $400,000. You pay back roughly $910,000, more than $500,000 in interest alone, on top of what you actually borrowed. Now stack 3 decades of property taxes, insurance, and maintenance on top of that. Conservative estimates push the full cost of simply owning that house, not buying it, owning it for 30 years, well past $1 million, on a house advertised at $400,000. That number does not appear on the for sale sign. There's a second cost, too, quieter than the first, and almost nobody calculates it: the money that never got invested anywhere else. Every extra dollar that goes toward a mortgage and its expenses, instead of, say, an index fund, is a dollar that stops compounding. The stock market has historically returned somewhere around 7 to 10% a year before inflation. If the gap between renting and owning, that $1,700 a month difference in places like California, had gone into the market instead, compounded over 30 years, it would very plausibly be worth more than the equity sitting in the house. That's the trade almost nobody runs the numbers on, because one side of it is invisible. You can see a house. You cannot see the version of your life where you didn't buy it. For decades, the pitch has been close to religious. Real estate always goes up. Renting is throwing money away. Your house is your biggest investment. Here's the quiet irony nobody likes to sit with. Mortgage interest is also money you will never see again. It just comes with better marketing. Nobody calls $500,000 in interest payments throwing money away because it arrives wrapped in a story about stability and building something. Renters get told they're flushing cash down the drain for, functionally, the same financial behavior wearing a nicer outfit. Part of why that math rarely gets questioned is that buying a house was never really sold as a financial decision in the first place. It was sold as a milestone, proof you'd become a responsible adult, the thing you do right after the wedding and right before the kids. Question the spreadsheet, and you're not just disagreeing with a calculation, you're disagreeing with a life script handed down by parents, in-laws, and roughly 4 decades of commercials featuring golden retrievers running across front lawns. That's a much harder thing to argue with than an interest rate. The always goes up claim doesn't hold up the way people assume either. Adjusted for inflation, U.S. home prices stayed roughly flat for most of the 20th century. The dramatic gains people associate with real estate are mostly the story of the last 25 years, and even that story has a chapter nobody likes to revisit. In 2008, prices fell, and millions of homeowners discovered that a 20% down payment can be wiped out entirely by a 20% drop in price. Leverage cuts in both directions. It just only gets celebrated in one of them. Then there's the moving problem. The average homeowner sells and buys again about 13 years. Each move resets the amortization clock, dropping them right back into those brutal early years where most of the payment is interest, and each time they hand over 5 or 6% of the sale price to real estate agents on the way out. The equity people assumed they'd locked in gets clipped again and again every time they change addresses. The house was sold as an investment. In practice, for most people, it behaves more like an extremely expensive, extremely illiquid forced savings account, one with a management fee charged by the bank, the tax office, the insurer, and the contractor every single year for as long as you own it. the only subscription in your life you genuinely cannot cancel without paying someone 5 or 6% for the privilege of leaving. Zoom out far enough and this stops being a personal finance story and becomes a structural one. For most American households, the home isn't one investment among several, it's almost the entire portfolio. Most middle-class wealth sits inside a single, leveraged, illiquid asset tied to the fate of one local economy. If the factory closes or the company relocates, the same event that threatens your job also crushes the value of the only asset you own. Diversification, the most basic rule in investing, gets abandoned the moment people start treating a house as a financial plan instead of a place to live. The lock-in effect is making this worse, not better. With millions of owners refusing to sell low-rate homes, inventory stays artificially thin, prices stay artificially high, and a new generation entering the market is buying into a system where the old rules, buy early, ride inflation, refinance when rates drop, simply don't apply the same way anymore. They aren't late to the party, they're paying a cover charge at an entirely different door. Increasingly, that cover charge is being paid by someone else. A growing share of first-time buyers aren't qualifying on income alone anymore. They're qualifying with a down payment gift from their parents bolted onto the application. Industry insiders have started calling it, almost cheerfully, the family discount. Which raises an obvious question: what happens to the people whose parents don't have one to give? And the family at the open house bidding against you might not be a family at all. Large investment firms and build-to-rent operators have spent recent years buying up single-family homes by the thousand, converting starter homes into permanent rental inventory, and competing with first-time buyers using cash offers no ordinary household can match. When an investment fund and a 28-year-old with a pre-approval letter want the same 3-bedroom house, the fund usually wins, and the 28-year-old becomes its tenant instead. The climate insurance problem is only getting started, too. As more regions become harder and costlier to insure, the hidden line buried under taxes and maintenance is going to keep climbing, year after year, regardless of what happens to the mortgage rate. None of this means home ownership is irrational. Stability has real value. So does control over your own walls, your own decisions, your own space. But stability is not the same thing as wealth building, and an entire industry has spent decades blurring that line on purpose because the blur is profitable. For the bank collecting 19 years of front-loaded interest, for the insurer raising premiums at every renewal, for the contractor on permanent retainer for the next leaking roof, for the agent collecting 5 or 6% on the way in and 5 or 6% on the way out. So, maybe the real question isn't whether you should rent or buy. People will keep arguing about that forever, and the honest answer depends on the city, the rate, the decade, and the person asking. The real question is why an entire culture built its definition of success around the one asset almost perfectly engineered to extract money, slowly, quietly, for 30 years at a time, and then called it the smartest purchase you'll ever make. Maybe it is. Maybe for you it still will be. But it's worth asking, before you sign anything, exactly what you're buying. A home, or 30 years of paying in careful monthly installments for a story you were told long before anyone handed you the key. Either way, the house gets paid first.